Hello and welcome to Switzer. I'm Paul Rickard, filling in for Peter Switzer. This week, a special interview with Rudi Filapek-Vandyck. Joining me now is Rudi Filapek-Vandyck. Rudi, of course, is the managing editor and managing director of FN Arena, a great partner for us at the Switzer team. Rudi, welcome to the program.
Thanks for inviting me. It's a pleasure.
Look, I might just start with just a view on the market. We've seen the US Federal Reserve cut interest rates by 0.5%. Markets continue to sort of meander higher. How are you feeling about our share market at the moment?
I have been fairly constructive ever since late last year. So I haven't joined many other commentators that might have been more cautious and maybe a little bit more bearish about this market. Historically, the prospect of cutting interest rates has always been treated as a positive by markets, but it's probably important to emphasize that it's only a positive as long as we don't get negative economic growth. And usually when central bankers start cutting, that's when that negative economic growth is on the horizon, and they try to prevent that from happening. To my surprise, I must say, I was in the 25 basis points camp, and I thought the market was getting a little bit too excited about too little, but it turns out the market was right and Rudi was wrong. I guess the Federal Reserve here is putting a lot of emphasis on its messaging, because my thinking up front was if they do cut by 50 basis points, that might actually be taken as a negative by the market, because why would the central bank that has waited this long all of a sudden move by 50 basis points and not by 25? So they're putting a lot of emphasis on their messaging, and they think that they get their messaging right. I guess the logical conclusion to draw here is that they realized they had to cut at the previous meeting. They didn't do it. They found themselves behind the curve, so to speak, and they've immediately corrected that. They went 50, so we basically compensate for the fact that they haven't cut the previous meeting.
Yeah, but
they also made it clear we're not going to go in paces of 50, because that's quite an emergency setting, and the messaging from the Federal Reserve is there is no emergency, so there's no panic, and we just have started a cycle of low interest rates. It's good for it's good for investors to understand that if the soft landing, the so-called or no landing, soft landing, if that comes through, and we do get lower bond yields, lower interest rates, and inflation doesn't pick up again, then that's essentially great news for risk assets.
Yeah, and essentially what they've telegraphed with, I guess, the so-called dot plot, which is where all the members of the Federal Open Market Committee sort of tell us where interest rates going to be in the next 12 months, 18 months, 2 years, 3 years out, and in terms of what they're telegraphing there. But those dot plots have a pretty low accuracy rate in terms of whether they come true or not. But there's certainly signals that they're going to be, they're in the mind to sort of ease interest rates down over the next 12 to 18 months, haven't they?
Yes. And you're making a valid point. I still remember when almost nobody was paying attention to the dot plots, because they're not meant to be as a forecast. That's just individual members putting their finger in the air, basically. But the markets in recent times, maybe also because we have more automated trading, and so it pays a lot of attention to where those dot plots are going. The market is positioned for more interest rate cuts than those dots are suggesting. And I think the market is trying to have it both ways. I do think at one stage, probably, if we don't get a recession, then the bond market will have to reset for less cuts being implied. And at the moment, the bond market is positioned for more cuts than almost anyone thinks will happen, unless we get a recession. So I think there's a correction coming, probably in bond markets at some point.
Yeah. And in the equity market, we've seen the buy the dip strategy work pretty well and continues to work well. Do you have a sort of a view that that's still a good way to be able to play the market at the moment?
I think it's very difficult to talk about the market, I think, because the market, what maybe once upon a time was like 80% of the market or so of the share market. I think it's much more polarized these days. So I think as many investors would notice, it's not so much. Of course, it's a case of you have to be in the equities markets to have equity-like returns. But it's not so much to be in there. It's very much dependent on which part of the market is in your portfolio. And I think if the past decade or so has shown us anything, it can vary a lot, just dependent on what you have in your portfolio. And for example, in this year so far, the banks have, I think, surprised just about everyone, probably including themselves.
Mm-hmm.
And commodities again have after a promising start to the year have fallen out of bed, and so that barbell strategy has probably not worked that well, but and I think a lot of professionals are waiting for that pendulum to go the other way. But that's a big call at this point in time. I think if economic momentum continues to decelerate, then it's very difficult, I think, for commodities to really take over from the banks, unless the banks fall out of bed. But they haven't done so over the past 9 months or so, and that's a big call to make as well.
What about alternatives? And I think that's probably the reason why the banks haven't come down, is because really institutions, if they sell banks, they've got to do something with the cash. If they don't like the commodities markets, then it's pretty hard to find the other parts of the market where they can invest, simply because those sectors are so big in our market. But what happens if they do look a bit more broadly? Where would be the other parts of the market that you'd look at if you were perhaps lightening off on your banks at the moment?
Yes. So one of the parts of the market that has had a very mixed success is the bond proxies and the small caps.
Mm-hmm.
And small caps, and both basically the bond proxies as well. They've basically now been in a bear market for the best part of at least 2 years.
Yep.
There have been consistent calls to move into in both, basically. And in recent times, we've seen the REITs and the bond proxies make up some of the territory. Small caps, very, very, very mixed. We saw that also in the August reporting season. It has been very much hit and miss, and I would actually argue we had more misses than hits in August. And again, if the economic picture remains tough, and I guess it's very hard to reason that the immediate outlook for the local economy is not going to remain tough because the Reserve Bank is not cutting here. Then I think it becomes a case of yes, maybe you should have some bond proxies in your portfolio, and yes, maybe you should have some small caps in your portfolio. But I think it's you have to pick, you have to cherry pick, I think, and you have to be able to probably pick the quality ones and pick the ones that are in the right spot in the right sector, and they are around. I mean, I own some of them myself, and on the other end, also coming out of the reporting season in August, some of the stocks that I own have been punished in August.
Yeah.
But then it becomes a case of, is this just a one-off punishment, or is that business case, or is that investment case out the window? And I think it's much more the former case. So that's why I still own those stocks. I haven't sold them, even though in the short term they've hurt me. I have a few blue spots here.
Okay, well let's get to some of those, and I guess let me start with the winners first, because what we saw, as is often the case, our reporting season, some of the companies reported out, raised guidance, the market took their prices higher, they continued to be well bid. Do you want to run through some of the stocks that you liked out of reporting season, and where perhaps you still think there might be some value left?
Yeah. What is not often emphasized, and that's because media and commentators have I think have quite a skewed view towards the local technology sector. But and that's not just my view. I've read other reports from people who have assessed the August reporting season. The number one sector to outperform in August was the technology sector. And the reason why we don't hear that often enough is because everyone thinks they're expensive, and that's sort of where the story ends. But for example, I'm a shareholder in WiseTech, and WiseTech was definitely one of the outperformers in the season. And we've seen that in the share price as well. But there were others in the sector as well. I think a little bit broader than that. I think there are the early signs that healthcare is potentially turning around here. And healthcare, obviously, since COVID, has had quite a tough time. And again, it's not uniform, but some of the healthcare companies are definitely showing the first signs that there's better times ahead. And the banks.
Do you want to just sort of identify a couple of those for us?
Yes, ResMed was definitely very, very, very good performance. I would personally, even though CSL disappointed, I would personally still think that they gave enough signals that they're bearing their plasma business is back on track.
Yeah. So how do you deal with both those companies who've sort of get hit from time to time with the obesity drug sort of I won't say scare, but obesity drugs are going to do everything. So ResMed's performed strongly. CSL still seems to want to struggle around $300, but you think that there's a bit of light there for both those companies, or more light for CSL in particular, do you?
Well, at the moment, it's ResMed that's absolutely outperforming. I mean, it wasn't that long ago. The share price was $21. Last time I checked, I think it's 36, 37, something like that.
Yeah, it certainly came down with the last obesity drug scare, and has had a very strong pullback over the last 2 or 3 months. Yeah,
I think in both cases, it's the realization that sometimes a good company can go through a little bit of a tougher time, and that doesn't necessarily tell you anything about the longer term future. And as I tend to say to people with regards of CSL as well, I focus on the company underneath the share price, and they are still growing at double digits, as is ResMed. That the fact that the share price at the moment and even in the past 2 or 3 years hasn't generally performed, that doesn't tell you anything about the next 2 or 3 years if they continue growing at double digits. And history shows you that when companies grow at double digits year in, year out, at some stage the share price will respond to that. And I'm in both cases, I'm pretty confident that it's they're still on the menu for the years ahead.
Okay. And what about a fallen angel in Ramsay, which has been struggling, and it doesn't seem like it does anything at the moment. The market doesn't want to touch it. So
no.
But 5 years ago, we probably could have had the same conversation before COVID about Ramsay, and it was growing in its Australian business at 7 or 8%, and I guess that was when it got pretty aggressive offshore. But we all labelled Ramsay as the best healthcare operator in Australia. So talk to me about Ramsay.
Yeah, Ramsay. You can also throw in the ASX, the stock exchange as well. They're pretty similar in that respect. You can use both of them as a premium, high quality performer that gradually has lost that premium, essentially. And while I'm not in the position to say that things will never come good again for the ASX, I'm not that optimistic about Ramsay at this point in time. I think Ramsay has now a whole litany of problems, and not in the least too much debt. Way too much debt. That probably means they will be forced to shrink. And yes, I mean, that will probably mean the share price won't go much lower, and it might even go higher. But that's not really an attractive investment proposition, I find. A company that has to shrink to shore up their balance sheet and then ultimately still is left with private hospitals that not that much growth in there, I don't think. So I actually think that the glamour story of Ramsay Healthcare has ended. It doesn't mean that there's no returns to be had, but my favorite expression is don't expect fantastic things from a very ordinary company now.
Right.
I think we just spoke about ResMed, CSL.
Mhm.
I mean, another company in that same sector is Sonic Healthcare.
Yep.
They equally have gone through a tough time, still going through a tough time. I'd be more confident that at some stage, maybe 12 months from now, maybe 18 months from now, they'll be in a better position and they will start performing for shareholders again. With Ramsey, my confidence, I must say, is quite low.
Yeah. And do you put it down to the debt or more the fact that their overseas acquisitions just have been very difficult? It's a very regulated industry where it's very hard to raise prices. In fact, you face, in some cases out of France, price cuts.
I think the
Yeah.
problem it's all of the above basically. What one of the reasons why Ramsey performed so well for such a long time is they were constantly increasing their footprint, and they could use that successfully to also get better deals from suppliers and the likes. Now at some stage that effect has dried up, and what they were left with is basically being in the wrong corner of the healthcare sector. I mean, all those governments, be they in France, in England, and locally as well, they're all confronted with budgetary limits, let's call it like that, and they don't want to spend more money on, and they're basically looking. So basically, the pressure was on. If you go back in time, you can almost draw the line back to when Medicare or Medibank listed on the ASX. And from that moment onwards, every single year, the negotiations between the private healthcare or the private hospital operators and the insurance companies, they were getting tougher and tougher. And that's part of the proposition, of course. Someone is paying for the expenses on you and me. And if it's not the hospitals, then it's the insurance companies. And if it's not them, then it's the government. So it becomes who's going to pay for it? And at this point in time, Ramsey finds themselves in a very difficult position. The sector has literally collapsed in England, and it's sort of trying to find its footing again there. COVID obviously hasn't helped them either. The pressure was on in France, and the latest rumors are actually that they are probably going to pull out of France and just sell it off, if they can find a buyer.
Yeah, I mean, I think I'm not quite as bearish on Ramsey as you are, but I think it's a function. It's really a legacy of COVID, but has really been the biggest impact because it hasn't. Their costs went up, and they've been, as you said, the squeeze from the insurers has been consistent. But they certainly had a huge blowout in costs, and they haven't been able to recover it. And the activity levels haven't really gone up much. So let's move on a little bit. I want to come back to some of the positives. So we talked about some of the tech stocks. You mentioned WiseTech and healthcare. Any other sort of sector or stocks out of reporting season that you think still look like a really good value?
So some of the more, let's call them the more large cap boring companies have actually performed really well in August. Brambles comes to mind. Brambles is definitely, and you see it also in the share price. I see it in general sentiment towards Brambles. It really has turned around in a let's say the last 6 months or so. People are now really optimistic, and they come back from a Brambles presentation and they go like, these guys are going to do this, they're going to do this. 2 years ago, it was all like there's nothing happening there.
That's right. Plastic. I don't know if it was plastic pallets or what, but they were the chip pallet was dead. I think that's what they were saying 2 or 3 years ago.
And now they're going to use data and AI and you name it. Another company, Telstra.
Yep.
Telstra is definitely back on the menu for dividend seekers. People are now forecasting that we will see at least 3-4 years of dividend increases. And it was only a few months ago that people thought they will have to cut their dividends.
I never quite understood where that, not 3 or 4 months ago, a couple of years ago, yes, but the little sell-off in Telstra when they changed their pricing plan, I thought was just crazy. But anyhow.
Yeah, well, I guess that's the market sometimes. They thought, well, that means no revenue increase for Telstra, so no dividend increase. But yeah, that was quickly reversed. I'm a shareholder in Telstra, so I'm not too unhappy about that. One of the companies with a little bit more of a checkered history, QBE. Even though it was strictly taken again a disappointment, and so was Insurance Australia Group, but even more so than with the CSL. There was enough in those results that analysts kept a positive view on QBE now, and to assume that the bad old days when there was disappointment upon disappointment upon disappointment, that they are definitely in the past now. The insurance cycle keeps surprising people, and so those companies are definitely amongst the ones that are often quoted as having outperformed. There's probably a few other ones, but they do not necessarily all come to mind. The irony here is that one of the surprises was also delivered by Commonwealth Bank, but the discussion there is, yes, it was better than analysts had projected, and forecasts have moved up. But the discussion revolves all around, but the share price is already where it is, and that's basically the discussion over there. It's not that the banks can't still outperform expectations, because expectations are very low for banks. It's more a case of how much of that is in the share price, or how much do these share prices have to come down to reflect fair value again.
Okay, then let me go through on the other side a couple of stocks possibly to avoid. So we talked on the healthcare space. We'll want to see how you feel about this. A company that's come off the boil in the healthcare space is Cochlear. I was wondering whether it was looked at the chart today, and it seemed to go from about 260 up to 360 in the space of nothing, and sit at 360 for 6 or 7 months, and now it's back to sort of about 280.
Yeah.
What do you think of? Still on a very high multiple, but that's sort of, is Cochlear still yet to find a bottom, or do you think that's we've had the retracement there?
I think personally, we probably had the retracement. The funny thing with Cochlear is it's a bit like a CBA story. I mean, they always trade at a premium, and the premium can be quite hefty. Maybe when the premium is very hefty, you don't want to buy them, but you can still own them, I think, because you just have to take on board that the market is clearly taking the view that Cochlear can be relied upon for robust growth numbers, essentially, and they have a very strong they have a very strong market position. When people tell me the Australian share market doesn't have enough quality technology, I always point towards ResMed and Cochlear. They're global leaders in their field. What surprised analysts with Cochlear is that they first gave a positive warning, an upgrade basically to guidance, and then when the result came out, they had to downgrade the outlook. That's a bit of a strange way of treating your shareholders and the market. So the market was actually quite a little bit shocked by that, but nevertheless, similar as with CSL and with ResMed, sometimes there comes a period when they don't grow double digits, they just do single digits, but it doesn't mean that they can't go back to double digits. And I think with Cochlear, I don't think there are any signs that growth story is at its end or anything. Probably the opposite. They're finding new layers of society that also needs their implants. I mean, like with every growth story, are they going to grow indefinitely? No, but in the same respect, there's still probably many years of growth ahead of them. So if you're a shareholder, you're obviously happy to stay there. If you want to get on board, you just have to take on board that it's a premium company. It trades at a premium, and you can't just put traditional valuation metrics on it, because that means you will never be able to buy it unless we go through a 2008 situation or 2020 situation or something like that.
Okay, speaking of premium valuations, Pro Medicus goes from strength to strength.
I think that one astounds so many people. It's regarded now as the quality growth stock we have on a stock exchange. That may or may not be true, but usually those opinions are formed by the share price. And I don't think anyone will claim that the share price hasn't performed. It's amazing. It's absolutely amazing. It's like that share price can't stay down for more than 2 seconds. I actually don't know what to say. I am very much in favor of this company. I know they're on the right track. There's a lot of growth ahead of them. And just like everyone else, I am just absolutely amazed by the share price and the underlying valuation. And I guess if you everyone who got on board, even if you did it a year ago, I guess you just close your eyes and get on board and just take the ride basically, because you can't do it on valuation. It's very difficult. But then maybe that also makes all of us realize that there's more to a share than simply valuation. And I don't mean just like the next guy. I don't know when share price will weaken, but I do know one thing, and I'm definitely talking not for myself, not just simply for myself, but probably for a lot of other people. If a day comes along that by some accident or for whatever reason that share price falls a lot, I think there will be a lot of buyers waiting to get on board.
Yeah, the pullbacks have been so brief and so quickly
Yes.
bought. So I've been watching it now for the last $60 or $70. I haven't been able to buy yet, but I'm kicking myself every day. Look,
Join the
finally,
club, Paul. Join the club.
let me just deal with a couple of fallen angels. One I get asked a lot about, Rudi, is the gas pipeline company APA, which used to be, I thought of it, considered as a bit of a bond proxy, but it's really struggling to find much upside.
Yes.
What's your views on APA?
I used to always tell people that is the most reliable dividend payer we have on the stock exchange, and it has been for like lots of time. I guess the risk profile has very much changed, and you're right. There are now more questions about what is actually happening there from the regulatory side, but also their ambition is to move in the United States. We haven't
But
seen.
they haven't done that though.
We haven't seen too much of that. But that's more an indication of how difficult it probably is.
Yeah.
Because they are hell bent of they have communicated that a number of times. They want to go into the United States. Locally, they do have some pushback locally as well because they are a major player already. So I guess what I said earlier about companies like a CSL, like a Sonic Healthcare, and like a few other ones, ResMed, there comes a time sometimes when even those trusty, reliable performers, they simply go through a little bit of a tougher time. And with APA, I don't think that we should be afraid that they all of a sudden gonna halve their payout or something like that to shareholders. That's not gonna happen. But what might happen here is that they may not be able to keep increasing their payout, even if it's only for the next year or maybe the year after or something like that. And that, all else being equal, means that in inflation adjusted terms, you are going backwards. There is also some speculation that given their ambitions they have, they may actually have to come to the market and raise some capital at some stage. Not everyone likes that. But I mean, I'm a shareholder in a company like NextTC. When they raise capital, just take the capital, I would say. When it comes to APA, that's less of an attractive proposition because they're not necessarily going to double their profits because they raise extra capital, and that's just a different proposition. So I don't think they should be thrown in the bin here, but I do think they're going through a tougher time. Risk profile has changed, and that by definition has made them a little bit less attractive for groups of investors, I think.
Okay. And maybe just to close, Rudi, and put you on the spot, is there one stock at the moment that you really like?
Oh, I like a number of stocks, but
okay, well, give me a couple then.
So one of the stocks that got punished in August is Data. And I quite like Data, and one of the reasons is not because the founder is a bit of a character who now lives in the Middle East, but I am a firm believer in that. In particular, the few years ahead are going to be dominated by AI and by investments in AI, and as small businesses will catch up on AI and also consumers. I think Data will be one of those companies that should benefit from that. Right. So I bought them near the lows of from memory last year, and they were an excellent dividend stock back then because share price was so cheap. And then from the moment they recovered, I've kept them because I think they, on a 2 to 3 year basis, they should benefit from us, you and I, starting to buy AI products, and I think they should benefit from that. Apart from that, I think it's a relatively good, well-run mid cap stock.
Okay, all right. Well, we might leave it there. Some great ideas. I did take on board your comments about both CSL and ResMed, and I think it's as you say, we do have some really good technology and still healthcare leaders in the Australian market that people forget about. That there are quite a few companies that are global leaders in their field and showing some good rates of growth. So certainly, I think there's some good advice about having a look at those and getting your portfolio a little more balanced towards some of those companies. As always, great pleasure to have you on the program. We wish you well, and we'll keep reading FN Arena. So that's Rudi Filapek-Vandyck. He's the Managing Editor and Director of FN Arena. Rudi, thanks for joining us.
Thank you, Paul.